Thanks, Joe. ADP saying the private sector grew by 89,000 jobs in the month of September. That is a miss compared to the stronger estimate of 160,000. The goods sector up by 8,000, the service sector up by 81,000. All of this compares with a non-farm payroll estimate for Friday, which includes government and the private sector, of 170,000. Looking at the job growth by business size, small businesses doing their part, medium businesses doing their part, up by 79,000. It was large businesses that saw the decline, down by 83,000. That's a big change from what's been going on here. And by sector, there it is, the leisure and hospitality business doing its part, up 92,000. Financial activities also stronger. Kind of curious given what's happening in the mortgage market. Construction also doing well, but trade, transportation, and utilities down 13,000, and professional business services down by 32,000 right there. Wage gains also showing quite a bit of moderation. Those staying in their jobs got year-over-year changes of 5.9%. That's one of the lowest we've seen since 2021. Job changers, 9%, still high by the history, quite a bit from, it was, I think, 15% just about a year ago. So some good numbers there when it comes to the inflation outlook and the impact potentially from wages. And just a quick caveat, guys, as you know, this number has been running quite a bit hotter than the BLS number, about 100,000 over. So they don't claim to be trying to mimic it or mock it. They're just doing their own report on what's happening in the job market. Joe?
Okay. So just to recap, yesterday, one of the main catalysts in the market was that the JOLTS report came in, which was meaning that the Fed was going to have to go further and hold rates higher for longer, which, again, I'm getting really sick and tired of this term, higher for longer, because we don't know what higher means and what for longer means, but everyone seems to want to use it consistently. But today, one day later, we have the ADP report, which says just the opposite. So you have these morons come on here and tell us that yesterday, this is what's moving the market up or down, and today it's moving the market up. Well, which is it? Again, it can't be both. I hate it when we have these contradictions. Now, I understand they're two different reports and I understand they say two different things, but we are so quick to grasp what's going on and try to make sense out of everything that's going on. We fail to stop and actually look at what's going on realistically. Now, what I want to make a point on this, it's really quite simple. Now, market's just closed. What I really want to point out for you here is literally this. So we finished the day at 13,236.01 on the NASDAQ, just as an example. And yesterday, with all the hullabaloo going on, and we're basically back to where we were Monday morning. And I know it's kind of in between here, but if you kind of pulse it up, we're in essence right back to where we were there, or yesterday. So if you had done nothing, you'd be right back to where you were, which is kind of the point. The market isn't run by this. I mean, clearly on a one-day basis, we went up and down. But here's the other kick. This Friday, we've got a whole new payroll report that's going to come out, and it's probably going to say something completely different. So if you're going to take any one of these reports and just look at them in itself, unless you're willing to day trade, it's not something to actually invest on, because none of it means a darn thing. And I'm not saying the Fed isn't looking at each one of these things. I'm sure they are. But it is not the end all be all and is not going to make or break any of this stuff. What I find more interesting on this is that we'll look at this kind of thing. And they've talked a little bit about yields pulling back today. Because again, why did the market go up today? Was it because of the ADP payroll? Why did the market go down yesterday? Was it because of the JOLTS report? Highly doubtful. I don't think either one of them had anything to do with anything. I think what you had is yesterday, you had yields going through the roof and the market went down. Today, the yields pulled back from a 15-year high and the markets went up. Again, could be wrong. Don't think I am. Because if you really look at what ended up going up, and again, kind of look on the sides, the S&P was up 0.8, the Dow was up 0.39, and the Russell was up 0.11. Now, what does that really mean? It means that small cap, mid cap are still significantly down. So even though yields did what they were, they went down today, the market did not respond by putting money into small caps and mid caps. What they did put money into were large caps that have a lot of money. Microsoft, Apple, Google, the big seven, or whatever you want to call them. That's where the flight to security has been for the last several years and will probably continue to go. Because I continue to say it's really difficult to get away from those stocks. I mean, think about it. They run this world. And more importantly, when you see people putting money into their 401k plans every single month, month after month after month, and those fund managers where they put the money in the 401k or putting them into mutual funds, the fund managers have to put the money to work. Well, they're putting into money to work to compare to the S&P and the Russell and Dow and the NASDAQ. Well, if they're tracking the S&P, they've got to put the money in to the stocks. Well, if 6% of the S&P or 7% or whatever it happens to be is Microsoft, Apple, or Google, they have to put them into that. So those big stocks are going to continue to get money plugged into them every single month. And it's just going to continue to prop them up. And I don't really know if it really matters what their fundamentals are really about anymore. I do think it's more about what's going on in the total market. And I think the market has, over the last several months, because interest rates have been going up, that's been a bigger mover. So I don't think it was the ADP report today. I don't think it was the JOLTS report yesterday. But one of them I did find interesting, and I think went under the radar, was this one from a couple of days ago.
Meantime, one of the Fed's voting members next year is out with some new comments on the economy. Let's get to Steve Leisman with those headlines. Steve.
And important ones. Atlanta Fed President Dr. Bostic, the coming month, the Fed officials just say outright he believes the current Fed interest rate is, quote, sufficiently restrictive. That's the benchmark.
Okay, so now we have Bostic, the federal funds with the Fed, saying that monetary policy is sufficiently restrictive. Why didn't we talk about this one earlier? Why haven't we made this a big deal? Because honestly, this is the most important part. Because it doesn't matter where rates are today, because if the Fed's not raising anymore and they're done, or they're going to start cutting, what happens in the rates today are going to completely change for tomorrow. And this is actually the Atlanta Fed president saying that it's sufficiently restrictive and that we don't need to go any higher.
Forged by Fed Chair Jay Powell to determine if the Fed can stop and hold rates at current levels. I'm very much in a place, he told reporters earlier today, where I think our policy is sufficiently restrictive and that we can be patient. Fed Vice Chair for Banking Supervision Michael Barr yesterday said the Fed is at or near that level, suggesting he's close to Bostic's view, but not quite as definitive. Bostic's comment could mark him as an outlier on the board, with several Fed officials recently suggesting that they would favor an additional hike, and 12 of 19 members actually forecasting one.
Okay, so here's my question. Let's make an assumption that all of the data that we get continues to be what we continue to see, which is a JOLTS report that says it's too hot, an ADP report that goes it's too cold. We see CPI that comes in, the headline's a little bit high, but the core is still coming down. We get all these mixed signals. What is the Fed going to do? There's nothing definitive to tell them that they aren't restrictive enough. There's nothing definitive to tell them that they're too restrictive. There's nothing definitive to tell them to do school. So what if they don't do anything? And yet the economy just keeps plugging along like it has been for the last 2 years since Powell came out and said he was going to raise interest rates. What then? To me, that's the bigger question. And I wish we would spend more time focusing on, again, reality rather than, yes, we've got some reports that are coming out. Don't take one report and run with it, because it's not what's running the market. Don't take one Fed official for their opinion. Now, we've actually had two here that have come out and said that they think they are, and again, you can pair the words they actually say and break it into a bunch of different parts, but that's not exactly what any one of them has said. They all are of the opinion that they're either there or really close, but they're all going to be data dependent. Well, what if the data doesn't tell them anything different? What if the data doesn't say to go up or down or sideways? I think it's really going to be this word right here, which is patient. And I think that's where we're at with the Fed. I think they're going to be patient. I don't think they need to go anywhere. And I think we're going to get a whole hullabaloo about this. You're going to get a bunch of people come on here and say, well, it's going to be too far, it's too long, it's too high, it's too whatever. Again, go back to the 90s. The 90s were a great time for the stock market. The 90s were a great time for the economy. That doesn't mean there weren't ups and downs, not saying that. What I'm trying to get at is that where we're at with the Fed funds rate is not going to kill the economy. It's not going to kill anything. And I think with the technology that we have, and when you look at how quickly technology is increasing, that is where we need to focus going forward, because what's going to happen is technology is going to lead us out of this. And we're seeing more and more companies try to get past all of these little bumps in the road, so to speak, by using technology, which again, part of it's going to be AI, part of it's just other technologies that are coming. They're just coming so much faster and faster and faster. We're getting quickly through all this stuff. So again, as an investor, do not look at an individual report. Do not look at an individual time, because it's not going to do you any good. Again, we're right back where we were yesterday. So what I'm trying to focus on is, where is the Fed going to go? I think we're going to get a better idea where we're going to be at. And if it's not this month, it'll definitely be in December. But unless the overwhelming amount of data, not a single report, is showing that we're going in the wrong direction, I don't think you're going to see the Fed move at all. And I don't think they need to move. And I think they know that. I think their plan, without saying it, is that they're not going to make any moves, that they're not going to do anything unless the data just comes out as overwhelming in the favor of them having to do something different. At the moment, they're in great shape. They've got this. The market is still moving forward. The economy is still moving forward. The consumer is still spending money. Things are slowing down, but they're not going to a screeching halt. Do they need to be careful? Sure they are. And I do think that's probably what they're looking for. I think they're really making sure that they don't go too far the other direction. I think they're going to try to keep that. I mean, there's always going to be the pendulum, and I think they're going to try to keep the pendulum from swinging too far the other direction, because I do think it's come back the other way. And the question is, when do we get to the precipice at the bottom? So that's my opinion. Don't run with any of these things. Talk to your financial advisor. Make sure that your portfolio is where you need it to be for the long term and the short term. Dickie out.